Well, good morning, everyone, and welcome to today's webinar. And this is on the Global Green Finance Index number 12. I'm always surprised at indices that start and run, and the Global Green Finance Index is no exception. And today we're going to be exploring how things are changing in the world of green finance. Now, you'll know me. I'm Michael Mainelli. I'm one of the directors of ZN, and it really is a privilege to be able to introduce so many of these events, but I can only do so thanks to the many, many sponsors who support us in all of our work, and also, of course, the immense support of the team here at ZN that tries to make me look good as I talk about the results. So let's have a quick look at today's agenda and what it involves. Well, first of all, we're going to be seeing the results. And then secondly, I'd like to make some observations. But the most important thing today is you. And we've reserved quite a bit of time for comments, questions, and observations. So please do use them. Three points in particular. One, yes, the slides are up, but so too is the report. And there's a link to the report, which is just being published now on the GoToWebinar area. Secondly, we are going to be having the Q&A, and you're probably saying, how do I participate? Please, again, use the GoToWebinar question and answer facility, principally because Mike and I, who are going to be doing this, are here with you. We're not answering WhatsApps or emails or anything else. So please do type them in. All of those comments, questions, and observations will be answered if we don't get time on this particular program. So do get those in early if you possibly can, and then we shall pick them up. But most finally, what about today? Well, the big thing about today is that there are some real changes afoot in green finance, and we're seeing a bit of a divergence here between those who believe if we're talking green, it's about taking the C, i.e. taking the carbon out of ESG and making those markets work, or whether or not an enormous all-over ESG approach is the right way to induce change to save the environment. So some interesting comments there. And we do have a special supplement, as we always do in GGFI, and this one's special supplement is very much about the importance of finding ways to solve the global space debris problem, but more on that later. So I'll move on to the next slide, which is to just simply say I'm going to hand over to Mike Wardle. Mike is the Chief Executive Officer of ZN, but also the head of all of our indices. Mike, the floor is very much yours.
Well, thank you very much, Michael, and welcome to the event, those in the audience. A bit of background first about the Global Green Finance Index. We launched it in 2018, and really to track the development of green finance in financial centres across the world. GGFI 1 back in 2018 included 47 financial centres. The latest edition, GGFI 12 today, includes 94 centres, and I think the message there is that green finance has become more and more central to the development of finance across the world. And the index has three purposes, really. First, to encourage financial centres to do more and increase the depth of their green finance, to showcase best practice, and to foster a race to the top. The GGFI is a factor assessment index. This means we take account of two different sets of data. First of all, questionnaire responses. So we regularly ask finance professionals to rate the financial centres which they know on the depth and the quality of their green finance. And we then use a different data set, which is now 130 quantitative data measures, which we call instrumental factors. And we use machine learning to look at the correlation between those two sets of data to create the GGFI rating. So a bit about GGFI 12. First of all, well, who gets involved? In terms of the survey responses by sector, we have a really good spread across financial services sector, whether it is in capital markets or insurance, banking, investment, or in the knowledge and professional services sectors. So very good. And again, by region, we get most of our responses do come from Asia Pacific and from Western Europe, but we have a fair number of responses from all parts of the world. So people do really get involved. And then in terms of the GGFI world, where are the 94 centres that we are tracking? When we first started the index back in 2018, there were far fewer of these places on the map. And in particular, you would have seen maybe one centre in Africa, a couple of centres in the Middle East. So what we're seeing is very much emerging green finance markets coming to the fore. And in particular, we've seen the growth of the centres in Africa taking interest and having a rating in green finance. So the headlines from today's publication. First of all, London retains its first position in the index, with New York still in second place, so no change in the top two places. Geneva moved up in the third place, with Zurich and Singapore also moving into the top 10, replacing Amsterdam and San Francisco. So while in the top 10, we have Western European centres now taking 6 of the places, with US centres taking 3, but Singapore enters the top 10 as the only Asia Pacific centre in this leading group. And we've noted in GGFI 11 that Asian centres were certainly making a move, and that seems to be borne out by that result. The margins are very narrow, separating centres at the top of the index. Amongst the top centres, 10 centres, the spread of ratings is 20 out of a possible 1,000-point score. So it really is very, very tight in terms of the competition to be the leading green finance centres. And overall, the average rating in GGFI 12 rose just 1.28%, and that was a change from GGFI 11, where there was quite a large average increase. And we had 22 centres falling in the ratings in this edition. We ask our the people who fill in our survey, what are the drivers on the development of green finance, and policy and regulatory frameworks continue to be identified as the leading driver. And this does distinguish green finance from many other sectors in finance, and saying actually the importance of government policy, government and local regulatory policy in driving green finance is absolutely central, which is an important message when we're going towards COP28. So looking at the top 20 centres, as I mentioned, London, New York continue to take the top positions. Geneva and Zurich now in third and fourth, so Swiss centres very strong. Luxembourg in fifth place, the leading centre in the European Union centres, and you'll just see across the top 20 real strengths in Western Europe and in the US, but with some Asia Pacific centres also in the mix. So Shanghai and Seoul, Melbourne and Sydney, alongside Singapore, sitting there in the top 20. And in the GGFI, we look at two aspects, two dimensions of green finance. One is depth, which is about how much of the finance taking place in the centre is affected by green. And second, the quality. So if green finance is taking place, what is the quality of the work that's going on? And you'll see that London scores scores first on both of these dimensions, and while New York is second on depth, it falls to fourth when you look at the quality ranking. So there are some real differences and distinctions between the quality and depth scores. Somewhere like Amsterdam, for example, 18th on depth, but moves up to 6th when you look at quality. Chicago, a similar pattern, 23rd and 7th. So we really are looking at financial centres in terms of quality. Probably means they have good people, they have good skills in the local economy in terms of green finance. But if their depth score is a bit low, it maybe means there isn't as much green finance taking place in that centre as might be good for them. And we can track the relationship between depth and quality, and this slide shows that relationship. And those centres that are further away from the trend line or the correlation line are those which have that most marked difference between quality and depth. So somewhere like Philadelphia very much seems to have more depth than quality on this assessment. Somewhere like Cyprus is very much the other way around. It's seen as having very good quality green finance, but not as much depth at the moment, and maybe that's just about the size of markets. Looking at the ranking then in different ways, we use 4 different instrumental factor groups or areas of competitiveness. So we take the quantitative measures and we assign them into sustainability, business, human capital, or infrastructure. And then we run the same methodology, the same algorithm, but just taking the quantitative measures that apply to each of those groups. And we see some differences when we look at the rankings on this in this kind of way. London and New York, of course, perform very well across all 4 of the groups, but you'll see that Geneva just edges out New York on human capital. Geneva and Zurich scoring very well across the board. But then we have some quite significant differences. So Montreal at 7th for human capital, and that's a real improvement on the overall position. In other areas, people are up and down. So it's a way that financial centres can track their performance in terms of the different aspects which go into creating an all-round green finance centre. We do a similar exercise to take only the respondents to our survey that come from particular sectors of finance and combine those through the algorithm with all of the quantitative measures. And this looks at, therefore, we can sort of do the ranking by industry sector, people working in policy, working in the knowledge markets, in capital market investment, professional services, etc. And on these measures, we see that, again, London and New York score very highly, but Beijing actually comes way up the list for when you're talking about people in capital markets and people in the knowledge industry in green finance. And that's probably to do with the mix of people who complete the survey, but also the immense depth that China is putting at the moment on green finance from a policy level. And I mentioned to Michael the other day that when I was in Shanghai in June, the president of the People's Bank of China gave a 20-minute presentation to the conference I was attending and spoke only about green finance for those 20 minutes. So that maybe is a reflection also of that emphasis in China on green finance at present. I'm going to briefly go through some of the regional headlines, I guess. On Western Europe, in the top 20, these are the results. As we've mentioned, many Western European centres performing very well, and the fact that we have a large number of European centres in the top 20 and top 30 is a testament, I think, to the amount of green finance attention being paid in Western Europe. Looking at the Middle East and Africa, Dubai is the top-ranking centre in the region, with Abu Dhabi a close second, with Casablanca the leading centre in Africa itself. And there's real growth, as I've mentioned, in the number of financial centres now taking green finance seriously across Africa. And we do see improvements in the ratings for almost all centres in the region. In terms of Asia Pacific, as I mentioned, Singapore now in the top 10 with a chasing group of Sydney, Melbourne, Seoul, Shanghai, but a number of other financial centres, particularly in China and Korea, pushing up the index rankings. And so I think we're going to see that continue, that Asia Pacific centres are going to continue to produce a challenge to Western European US centres in green finance, as they have over time in general finance and the tracking we do through the Global Financial Centres Index. In terms of North America, the real story of this edition is that we have 4 new centres from the US enter the index. So we've known for some time that Los Angeles, San Francisco, alongside New York, have been performing well. But to see new centres such as San Diego, Atlanta, Philadelphia, Miami featuring in the index, again, just shows that green finance is making inroads into places which up till now have not been strong in that area. Looking at Eastern Europe and Central Asia, we see Cyprus enter the index for the first time and with a very credible score. But Astana is the clear leader in Eastern Europe and Central Asia in green finance and continues that to be in that position some way ahead of Istanbul. Looking at Latin America and the Caribbean, again, all centers in the index improved their rating in this edition. Bahamas is new to the index. Santiago takes first place from Rio de Janeiro, and it's good to see ratings coming back in Latin America and the Caribbean. I'm going to hand back to Michael now for some more general observations, but they're the headline news for the moment.
Great. Well, Mike, thanks very much for that swift overview. I'm always impressed at how swiftly you get through what is a tremendous amount of content. But the idea, folks, is obviously to encourage you to go and explore it yourself and to dig into it. Now, on to some of the observations I might make by way of commentary. Mike has pointed out the various shifts and changes. And as we look at the sector of green finance, it was, as I've said quite often, very much a Western European affectation for quite some time. And that began to change about 5 years ago. And those changes have deepened enormously. I point to two, frankly, in my opinion, geopolitical shifts. The first one is the importance of China. It was 2 years ago in July that China created a national emissions trading scheme, and the earnestness with which China is pursuing net zero is impressive to behold. China has come in for a lot of criticism because it's a big country and has been growing very, very rapidly. Its share of global emissions, of course, has risen. But I can attest that in 40 years of traveling to China, I would say it was about a quarter of a century ago, I began to see an earnestness emerging about green issues, green targets, et cetera. And that has continued. And that Chinese emission trading scheme is, in my opinion, one of the game changers really of this decade, not least because we now see that something like 23% of global emissions are now covered by a credible emissions trading scheme. And that's very impressive. For those of you who remember, we began in 1997, December thereof, at COP3 in Kyoto with a commitment, a global commitment. When people say there are no global commitments, there are. There was a global commitment to use the carbon markets to reduce carbon. China's, of course, accession to this approach is very, very important. And it's important as well to remember that the emission trading schemes that are up and exist and are credible, that do cover that 23%, tend to cover only about 50% of emissions. So were they to rise to cover 100%, and that's in the case of Britain or Western Europe and China, we would get ourselves on up to about 46% of global emissions covered by a credible scheme. And as any kind of credible scheme would be, in fact, decreasing the amount of emissions to zero by 2050, or as China has said, we can't do 2050, but in all honesty, we can do 2060. That would happen. So as Mike's pointing out here, we asked respondents to the survey to assess the proportion of global emissions they thought will be covered by carbon pricing schemes by 2030. So we're looking here at an increase from 23% to 30% as our sort of target. The question was carefully poised to give them enough indication so they weren't wildly guessing, but to get some feel for the strength of opinion. And well, sorry, not the consensus, but 50% of the people basically responded saying that in 7 years, they would expect to see an increase of 7%, more than 7%. And in fact, if you take into the other 22%, 3/4 of the audience thought we would hit 30%. So that's an increase of at least 33% from where we are today at 23%, if you're following. This is my statistics for you. But the consensus very much that by 2030, we would have about 30% of emissions covered. So that's a pretty impressive rate of growth. It's not sufficient, I think many people would say, I would, but it is at least very encouraging and not considering static. Now, if we could just turn back, Mike, sorry about that, to the slide before this one. The comment I really wanted to make about this slide was that our team brought this to me one day and said, hey, boss, have a look at this one. And I thought it was very, very fascinating. What you're looking at here is the consistency between those who are running a global financial center and those who are running a green finance center, and the conjunction between the two. And in early editions of this slide, there were numerous patches of red and amber. And what you see now here is really only two red zones, Tokyo and Hong Kong, where the green finance depth don't seem to quite match the strength as a financial center. And you do see, obviously, a lot of yellow/amber, depending on which side of the Atlantic you're on. And that shows you this increasing convergence. So in each edition of GGFI, we have seen a convergence between green finance and normal finance. And there's a lot to be said for that. I mean, to some degree, why is green finance special? And green finance is really only special because we haven't properly priced in the pollutant of carbon. Now, that's in one specific zone, which is the carbon area. I think when you get into some of the other spaces in the environment, forestry, water, biodiversity, fish, then it's far more complicated. And I can see the need there for special types of finance mechanisms emerging. So if we could skip 2 slides forward, Mike, my apologies for jumping on it. We mentioned specifically, of course, a very interesting area, space and space debris. Well, the space debris problem is much greater, I think, than many people understand. It's all whizzing around us, and so we can kind of ignore it. And we have a look at the stars at night, at least when there's not enough light pollution to keep them out of our eyes. But space debris is gargantuan. Man-made objects in outer space are now estimated to be approximately 1 million objects. From Earth, though, we can only track via radar objects about 10 centimeters. And in that case, we're looking at about 30,000 objects. Now, those 30,000 objects can do a lot of damage, but actually, so can most of the million objects out there. Space debris is a real and increasing problem. There was, in fact, a US scientist named Kessler who posited the idea of a Kessler syndrome, or syndrome anyway, it got named after him. And this was effectively sort of a fission reaction, so that one satellite hits another, and that fragments into 20 pieces, which in turn hit another satellite, which fragments them. And for those of you who've done your physics, pretty much like a fission reaction. And also like a fission reaction, a bit of an explosion that would block everything out. Now, the reactions that we've been talking about over the years are starting to just show a little signs of mini Kessler syndromes. There was one in August, which was there. For those of you who like science fiction, and Sandra Bullock, in the film Gravity, in which she starred about 11 years ago, there was Kessler syndrome at the beginning. Now, this has a number of consequences, and I would draw attention to 3 of them. The first is, of course, defense. If we can't get satellites up there, we can't see each other. And of course, it's not a good situation when nations can't keep an eye on one another because they tend to react badly. So there are genuine geopolitical defense concerns about making sure that space is kept open and available. The second one is a very selfish one. We've got an investment industry that's throwing objects up into space, billions and billions of dollars and pounds worth of investment in space, and the technology surrounding it, the data management, wonderful stuff. But do you want to throw billions up into low Earth orbit or high Earth orbit and watch it get shredded? I don't think so. So space debris could be constraining investment. And the final bit, and the most important bit, the point made here on this slide, is that almost 40% of the Sustainable Development Goals rely on space. So the Sustainable Development Goals, to remind you, come in 17 major categories. But those of you who know them well will realize that there are 169 sub-targets to them, about 10 per SDG. And the UN went through this in detail and looked at each one and said, could it be met without space? And they concluded that 65 of the 169, just short of 40%, call it 40% for short, cannot be met without having an effective ability to put satellites up. And why do we need that? Well, we need things like satellite monitoring of deforestation, we need or human trafficking. So if we're going to reduce it, We need GPS, obviously, for a whole variety of areas and various bits of special telemetry. And that's before we get into things like accurate timing and some of the advanced communications ideas and thinking that quantum computing and/or various other quantum technologies might permit. So we'll leave it at that. That's getting a bit grandiose, I know, a bit outer space. So that's the first thing. So I guess what we concluded here at Zien was something really perhaps ought to be done about this, that we needed action. And when you look at it, one of the interesting things here is that the in-orbit servicing industry is interested in this. There have been a number of firms who've made proposals to remove space debris. We, in fact, had one on the FS Club recently, Astroscale, a Japanese-British concern, who had done an experiment about 2 years ago of taking a piece of debris down. But who's going to fund that? And when you look at this and you begin to see that people are putting satellites up into orbit, it bears some resemblance, in my opinion, to the idea of decommissioning an oil rig, where you put up a surety bond that says that I will have to ensure that the rig is taken down, and if I default or if I go bust and I'm unable to do it, I have financial backing, typically from an insurer, who will ensure that the payments are made to get that oil rig decommissioned. So we're looking here, and now the next slide, Mike, on. We're looking here at the idea that what we should be doing is using the insurance markets. And there was a paper that we published at CN at the very beginning of this month on the website about in-orbit servicing in the insurance sector. We're holding an event here in London, for those of you in London, on the 5th of December, covering the space debris problem at Mansion House. That will be on the Zien website in a week or two. And we believe it's time for operators, insurers, and governments to come together to really look at this space debris problem. And I guess ultimately, what do you want, Michael? What's the target here? The target here is probably to make sure that the industry is prepared, and it is rising to it. But to get governments, perhaps the G7 or more likely the G20, to say maybe during next year that we will make it a condition of launch to have a space debris removal bond by 2020X. So we will make it a condition of launch to have a space debris removal bond by, say, 2028, to indicate to the operators that this is an increasing requirement and that the industry is prepared to support it. So it's been an exciting program. And there was, of course, the most interesting thing was that the Federal Communications Commission in America did, in fact, last month fine an operator who had failed to move a satellite away from a position in high Earth orbit to make space for others. So the attention to this is growing, and it is one of those sort of unseen long-term problems that could be solved, in our opinion, moderately simply by making this requirement for a surety bond. So we'll move on to a few other things here. Mike, if you wanted, I'll just summarize the key messages of GGFI 12. And the first one is that policy and regulatory frameworks continue to be identified as the leading driver in green finance. And whilst I tend to believe that it's important to move some of this into actual carbon markets, nevertheless, there are many, many areas of green finance where these policy and regulatory frameworks are at a very formative stage and need a lot of help. But COP itself strictly is about carbon, and that's where we would promote the interest in carbon pricing. I think is increasing as people are beginning to realize this is becoming a very material market. From memory, I believe we had $835 billion of permits awarded last year or sold last year. So it's a big market already. The third thing here is that the US centers have definitely caught up on green finance. And I said earlier that one of the great things was China, and then I forgot to say what the second one was. And that is, of course, clearly the sadly misnamed Inflation Reduction Act that the Biden administration has passed. But that has transformed certainly the nature of the US interest in green and the distribution of a lot of that largesse across the various Republican states by a Democratic president is, I think, showing that this is a big issue and one that is starting to motivate Americans to look at it differently. It would be nice were we to see the US consider uh, a national emissions trading scheme, which just to remind those of you who do get a little bit pessimistic, was in fact the US commitment in 1997 and perhaps might come back again. But that I think requires a look at US politics and some of the gridlocks there, although other nations do exhibit fairly similar situations when it comes to trying to get the population to realize that this green revolution does have some genuine costs. And finally, as I said earlier, the centers that perform well in GFI tend to be centers that perform well, or increasingly tend to be centers that perform well in the Global Financial Centers Index itself. So the conjunction there. But equally, and the studies are showing here, a little bit harder to show, but they are generally committed to environmental improvements across the entire economy. So there's a wider economy conjunction with green finance. And I recall a report by Spank Saracen that we published about 10 years ago, which indicated even then that some of the bond ratings on environmental issues coincided actually with good credit and sovereign ratings in the normal bond market. So, Mike, I think I'm just going to pause there, and I think you've had enough of my observations, and let's hear what the audience has to say. Great. Mike, if you pop back on, and we'll get cracking. Great to see you there, Mike. I guess the first thing is something odd. Just looking here, Elizabeth's asking, what sort of interaction do you have with the various respondents on this? How much do you get below numbers and questionnaires to personal opinion?
Yeah, well, thank you, Michael. But we do ask a series of straightforward tick box questions, as it were, on could you score these things? But then we also ask people who fill in the survey a couple of more open questions. The first one is to ask them which interesting or significant initiatives they know of in green finance. And there's a list of those on one of the pages of the report, which says, these are kind of the bullets which people have fed back to us. But they're quite often initiatives that are taking place in particular countries, in particular cities, which people want to bring attention to, and whether that is looking at the use of digital green finance tokens in the Bahamas, or whether it's looking at some of the sub-Saharan Africa green investment in solar energy. It's really useful to be tracking, I think, what people are getting excited about in terms of green finance development. And then we ask another series of questions, which is about people's views on particular areas, including the impact of regulation, the impact of taxation, the impact of skill development, and the availability of skills in green finance. And you'll find a flavour of that in the full report. We've taken some key quotations out from those comments, and we highlight them in the report, and we provide a kind of summary table as well. So we do try to track how people's sentiments are going. And the key issues, I think, are on availability of skills. People are really worried, actually. There is not enough it's green finance skill across the world. And that in some cases, you can start to see people having gone on a very, very short course on ESG and then setting themselves up as experts when really they're not experts yet, but simply because there's a gap in the market and people want to see that shift. And then a completely split economy on taxation, with some people saying that tax incentives are vital to the continuation of green finance, and other people saying, not all my life, leave it to the markets completely. The answer, as we probably know, is that some sort of policy and regulatory action is needed, and whether that's taxation or other forms of regulation or intervention will depend, I think, on the market.
Okay. Well, thank you very much for that, Mike. And I got a very strong subtext there. Read the report. As I say, there's quite a bit in it. And how many pages is it this time? 65, 70?
About 70, yeah. That's about that.
So there's a lot of detail there. But let's we're after your opinions, Mike. Now, Nicole Hortensa Mudenge is asking, what are your observations regarding the performance of African centers on green finance?
Well, thank you very much. And welcome, Hortense. Um, the story in Africa, I think, is that first of all, when we started the GGFI, I believe we're only tracking Cape Town, Johannesburg, and Casablanca as African financial centres. We now have Lagos and Kigali and Mauritius, in the mix, and Nairobi. And so the first message is that we are seeing African finance centres establish themselves and to start work on green finance. There's some way to go, I think. There's quite a few of the emerging African centres who are trying to do an awful lot of things all at once to improve across the board of finance. But we are seeing the beginnings of real strength in green finance in African centres. And of course, the issue, I think, for Africa is that the transition to get rid of carbon is a different shaped transition that will be in Western Europe, for example, or in the US and other parts of North America. And the way forward, therefore, may need a different mix of green finance products. And I don't think yet everyone has worked out exactly the implications and the detail of that. Some things are, standard green bond type investment in new types of energy infrastructure, but there are going to be, I think, other quite different types of financial instruments which African centres will be front and centre on because they're in the local market and they are dealing with local issues. So that's how I see things going, and I do see the African green finance market developing quite quickly, maybe starting from a little bit behind Western Europe and North America, but it will certainly come on.
Well, I must say, on a personal note, even in the last 4 weeks, I've had meetings on green finance with Nigeria, Kenya, South Africa, Mozambique. Yeah, so I think it's very much an area that's coming up. And of course, there's great interest both in the Middle East and in China in what could be done to promote green financing in these spaces. And then there's a great interest amongst, I think, some of the more advanced, what I would call private-public reinsurance type partnerships at what can be done to help improve the resilience of Africa against both some of the changes, but also against potential natural disasters. Quite similar to some of the work thinking that's been going on for a while in the Caribbean. Anyway, I'd like to move on to the next question. This is Wen Shangpei. What are the indicators of green finance penetration and quality evaluation?
Okay, so we don't define closely how we ask respondents to look at depth and quality, or penetration and quality of green finance. We simply ask the question, and we ask respondents to look at financial centres that they know about, and ask them really what the depth of green finance is and what the quality of green finance is on a 10-point scale. So we're really leaving it to the finance professionals who know what's going on in financial centres to give a judgment about how much green finance and how good green finance is taking place. But those assessments are really used when we look at the correlation with the quantitative measures. In other words, what those assessments are really doing is weighting the quantitative measures that we use in the index. It's saying, well, these quantitative measures are the ones that are associated most closely with the centres where people are rating the depth of green finance very highly. These quantitative measures are more associated with the places where they're associating quality of green finance closely. So the index is built by saying we don't know centrally which of the 130 quantitative measures that we use should be weighted in any particular way. What we do know is that financial professionals that know what's going on in financial centres will have a view about that, and we can use those ratings to, in effect, weight the quantitative data. So it's not a simple, straightforward answer to the question that was asked, but I hope that explains how we try to put together the two data sets to get a real indication of the depth and quality of what's going on.
Good. Yeah, it's a lot of hard work going into that. Got another question here from Andrew Ross. Andrew, great to see you online. Saw you last night. Andrew asks you, Mike, is GGFI Global Green Finance Index being presented at COP28?
The answer is not directly. I'm not going to COP28, although Michael, you'll be there in another capacity, perhaps. But very interestingly, the World Alliance of International Financial Centres will be strongly represented at COP28, and they are friends and people we talk to quite a lot. And it's very interesting, I think, that the Alliance of International Financial Centres feel that their contribution to COP is important enough that they're going in some numbers and holding events at COP28. I shall make sure, of course, that I brief both Michael for his attendance and my friends at the World Alliance on the GGFI and where things are going. But I think it does demonstrate, alongside the UN group, which is called Financial Centres for Sustainability, that financial centres and those who run them are looking really seriously at sustainability and their contribution, and understand that financial centres have a role to play in the development of sustainable and green finance, and that's very heartening.
Mike, we're coming kind of to the end of time, so you might want to slide over to the next slide while I ask you a final question. Folks, just as you can see here, we've got a whole bunch of forthcoming events on FS Club, but you knew that already. But notice here on Thursday, the 2nd of November, can financial engineering save the planet? And that's a good question. And it's a question I sometimes ask about COP. Mike alluded to, I'll be there in a different role. I'll be going down as Lord Mayor of the City of London to attend COP. And I'm very interested in what I see there, and the discussion of the blue zone, the government zone, and the green zone, the sort of circus of technology people all chatting. But I do believe ultimately that we've got to start making these things bite a bit more. And I'm glad that Mike and the team put so much effort into this index, which helps. Once you start measuring people, they do become a little bit competitive, strangely. But Mike, you've been traveling quite a bit and presenting the index widely. My question to you is, what's the biggest objection from people to it? I'm running a financial center. I get the numbers. There can be only one, so I'm probably not number one unless I'm in London. And I say, you've got it wrong. Why do they say you've got it wrong? What are the reasons, if any?
I think that people would say that the index has scored them wrong for a couple of reasons. First of all, because I don't know in sufficient detail what's going on in their centre, and if only I knew in sufficient detail what was going on in their centre, then I would have scored them differently. To which the answer is, this is about listening to the people who are working in the ecosystem in your centre and around your centre, but also taking a really hard look at the quantitative data. And it may be that you're doing great things in your centre and it hasn't yet fed through either into the perceptions of those who work with you or into the quantitative data, because quantitative data is always slightly time lagged. It's always historic. Or it may be that what you're doing, everyone else in the world is doing as well, because we do see financial centres looking closely at what's happening in other parts of the world, in other financial centres, and using the good ideas to ensure that they continue to improve their own centre. So one objection is simply you don't know enough about what's happening in our ecosystem. The second objection is that that somehow using perception data, using survey data at all, means that somehow perception is given greater weight than the quantitative data. And all I've tried to explain that how we try to combine those data sets. We do try to ensure that we don't have bias. For example, if you're in Tokyo and you score Tokyo, we ignore your score for Tokyo, because you've got a home center view of what's happening in Tokyo, which could be positive or negative. But we believe that the way we combine the perception data with the quantitative data is valid. The second piece of information, you can find some detail on this in the full report, is we do track reputational advantage, which is the difference between the raw assessment scores and then the final rating, which is given once we combine that with the the quantitative data. And what that allows us to look at is, whether some centres, their reputation is outstripping their is outstripping the reality, and those who could be marketing their reality a bit more strongly. Thank you.
Mike, holding this up simply because we've only got 30 seconds, but Chris Dyson's online, and Chris has brought out this book on heritage and modernity. So it's no surprise, as an architect and involved in the construction center, if you could just very quickly, in the time available, and also show people how they can complete the survey. Thank you for the great insight, says Chris. How can we make all this green finance more available to the construction sector? What channels are available? And just move to that final slide. Thank you.
Yes, I think it depends on the market you're in. In London, for example, the Green Finance Institute tries to bring together a whole lot of thinking about green finance, and there are various people in the ecosystem where you could start. In other sectors, you might want to start with an inquiry to the local financial regulator to look at opportunities for green finance. In other places, for example, in Astana, in Kazakhstan, there is a green finance center as part of the Astana International Financial Center, and you would start there. So it's very much a mixed economy. But just about all now investment banks will have a green finance stream, and investment institutions. Certainly, we're looking at sovereign wealth funds and saying, well, they all across the world now have a sustainability and impact investing focus. And what we're seeing increasingly at any investment institution who might be interested in investing in construction, or indeed in many other areas of infrastructure, will have a green finance strand as part of their work. So I think the answer is, if you're struggling to get green finance into construction, then perhaps we need to organise a webinar to bring together the people who could fix their minds on that. But on the whole, we're seeing more and more of the investment world with a focus on sustainability.
Great. Well, I'm afraid, folks, we've come to the end of time, and we appreciate you joining us here in London this morning. As ever, the indices continue. The next index production coming out will be the Smart Centres Index on the 23rd of November. We're seeing an enormous conjunction as well, not just between green finance and normal finance, but the much wider tech world and finances. They seem to be coming together. And then we'll take a small pause during December, Jan, and Feb, and come back again with the 6-monthly edition of the Global Finance Centers Index 34, which I think is actually 35. But anyway, we're doing quite well on that one. So we're really looking forward to seeing all of you at these various functions again. And please, thank you very much for contributing. And do share with your friends how they can take the GGFI survey if they feel that this is a field in which they have expertise. We really value opinions all over the world. So thank you very much. Thank you, Mike, for all the hard work that you and the team have done. And have a good day.
Thank you, Michael.